This is Inspiring Careers with your host, Ingrid Centurion. We're going to talk about fascinating technologies that will impact your future. Meet inspiring entrepreneurs and people that are making huge differences in the community and around the world. We're going to share career and life lessons of inspiration and success. Our mission is to inspire our viewers to make a better life for themselves by sharing our stories, our interviews, and documentaries. Please stay tuned as we have incredible guests coming up. I am at the Salem Five Bank with MaryEllen Giolito. She's going to talk to us today about student loan debt and what you need to do to pay off that debt. Thank you for being with us today.
Thank you.
How did you get into the financial business in Salem Bank? Tell us a little bit about yourself.
So I kind of fell into banking. My mom was a banker. She was a banker for over 45 years before retiring. And I had another job working actually as a manager in a restaurant. And when that restaurant shut down, my mother had suggested getting a job at the bank. And I was like, I don't know if I want to work in a bank. And I was like, well, I'd do it for a little while, just for the moment. And it's been well over 35 years now.
So it turned out to be a very good thing for you, because you were telling me about your background and how you purchased a house when you were very young.
Yes. One of the things I am very passionate about is bringing basic finance to younger kids, millennials, college-age students, even high school. I think it's just so important. Working in a bank, you're going to learn things that you will take for the rest of your life. It's, a lot of college-age kids, they might want to get a job, during the summer, maybe at a retail store or anything along those lines for the discounts. But what you will pick up at a bank, you will learn about retirement planning, you will learn about investment planning, you will learn about first home buying, to get your first home and what you need to do it. You'll learn about credit and how to protect your credit, how to protect your identity. So these are things that you just won't forget.
And with student loans and the debts that children are accruing, some of them are graduating from college with $80,000, $110,000. Someone from Framingham State, I was told, has accrued that much debt. So I want you to explain to us, what does the debt to income ratio mean? Because this is an important number that we're going to talk about today.
Yes. So back in my day, going to college and having any college loans, it wasn't the same thing. You got out of college and maybe you needed a car and you went to apply for a loan for a car. And they didn't include your student loan debt in that debt to income ratio. So it made it very easy to get, the car or the home or whatever you were looking to do. Today's kids, that debt to income ratio does come into effect because your student loans do get calculated into your debt to income ratio. And I'll get into kind of what the debt to income ratio is. But it doesn't get calculated as much as your credit cards, but it does get calculated in there. And if your average student has a debt of, say, $80,000 to $100,000, and that is definitely in the ballpark, you're looking, at the time they graduate, 6 months out, when deferment ends, you're looking at like $700 in loan payments, depending upon the kind of loans if you took out private, if you took out federal, that sort of thing. But you're looking at a significant payment in loans. So what the DTI is, and this goes for student loans, it goes for you purchasing a home, car, debt to income ratio. And it is an algorithm that the bank uses, a calculation that the bank uses, basic calculation. Every kind of debt you have, credit card, car loan, fixed loan or line of credit. Everything is calculated and it's scored differently. So credit cards are scored a little bit differently than your personal loans. versus your mortgage versus your equity versus your student loan.
Okay.
Okay, so when you look at your debt to income ratio, what that is it's your total of your monthly debt payments divided by your gross monthly income. And what the calculation they're looking for is somewhere around 43 to 45%. So in other words, your total debt should be no more than 43 to 45% of what your gross income is.
Okay, so we have a slide that we explain this. So take me through this slide here on, I've got rent, I've got a car loan, I've got my student loan, I've got my credit cards out there that I'm paying my monthly payment to, and let's review this again.
So if you add up all your debt, your mortgage, your rent, your car loan, and in this case, your total debt comes out to $2,290. And you take your income, and your total income for the month is $6,000. That's gross income.
And that's just graduating from college. I've got to find a pretty good job.
And we're going to get into that.
Right.
So if you divide that, you end up with a DTI of 38%, which is well within your means.
Okay.
That also leaves you plenty of room. They look at the 43, 45 as an acceptable DTI ratio so that you can still have fun. You can still go out and have something to eat. You can still go out to the movies. You can still have some entertainment value.
Okay.
You
All
can
right. That's
still
good to
pay
know.
your housing expenses and everything. The bills that don't come up, like your cell phone bill and your electric bill. So that gives you plenty of room to enjoy some of those niceties as well. And the reason I bring that up is because you hit the nail on the head. There's a lot of students that are carrying 80 and 100,000 when they get out of college. The question is now they have to get a job that's going to support paying that debt so that they don't have to worry about going into delinquencies or anything along those lines.
So we talked about that. What are the implications of not paying off your student debt, and how can that impact you for the rest of your life?
So with federal loans, private loans, when they're handled a little bit differently, but if you can't make those payments and you end up going delinquent on your student loans, it significantly impacts your credit score. That credit score is what the banks use when to find out if you have that credit worthiness to pay off the loan. So if you want to go for a car loan, or if you want to go for a home loan, they will pull your credit score, and it has to be within a significant a particular range so that you can afford that payment. Now, let's say you have a low score because you had some delinquencies on your student loan or any of your other debt. You might pay a higher interest rate, which means now the payment for that loan that you want to take out is actually going to be higher than it would be if you had a good credit score.
You had a friend, I think her name was Karen, and how she's 50-something years old and she's still paying off her student loan. And how has that impacted her life?
So,
because she deferred, and that's the last thing you want to do.
yes, so the deferment is good. Deferment has its place.
Okay.
It really does. But you also want to be aware of the implications of deferment. So in this case, Karen had gone to school to get her teaching certificate. And she really had a passion for teaching and teaching elementary school and middle school, and she did that. And then she became a professor, and then she decided, you know what, I would really like to go into law. So she had all this debt from being a teacher, getting her degree, and then she decided, well, I'm going to go into law school. And she went and applied for more loans, and she got through law school. And she is a self-employed attorney now, which is fantastic. But she has all this debt, to the point where She's living at home. Her parents have passed away, and they left her the house, thankfully, but not without their debt. So she has their debt, she has her debt, and she's got her car loan. She's in a position where, because she's self-employed, sometimes her income is up and down. Some months are really good months, some months not as good as last month. And without that steady income coming in, sometimes there comes a moment where she has to choose which is going to be priority, you know, and what I can kind of fall by the wayside for debt. And what's end up happened is that she's in a position now where it's affected her credit a little bit, to the point where she really is struggling to move out of the house, maybe into a condo, because of the credit score.
And
And she still got the debt.
right, she still has the debt. And tell me a little bit about how, if you don't pay off your student loan, the implications of when it comes time for retirement and Social Security. I
That's
don't
what I
think
was gonna
the
say.
average
Karen is
person
not
knows
alone.
that.
Karen is not alone. There are a lot of people my age that still have a lot of debt. And what basically happened is there were several people that had a lot of debt, and they defaulted on them. They just didn't pay their loans, and the government said, you know what, we need to get that money back somehow. So what ends up happening is the government does have the ability to, when you go to retire and you go to collect your Social Security, the government can take up to 15% of your Social Security right off the top to supplement and pay towards the debt you owe on your student loans. So that could be very significant.
What if you file bankruptcy? Does that still apply?
So it all depends on if it's a private loan, or a private student loan, or a federal student loan.
Okay.
So federal student loan, there's implications because it is a federal student loan, whereas a private loan, that's another ballgame.
Okay. So let's talk about some of the personal finance apps that are out there. You said there were really good apps out there that can help you with financing.
Yeah, so some of the tips, I'm just going to refer to my notes here because I really like this particular list of tips that was given. So it's my son is 22. He is graduating this year from college. He is right in that ballpark of having about $80,000 in student loan debt. And it's all fun and games while you're in college, but then, and he's been diligent on paying his student loans while he's in college, and he's still got the debt, and that nervousness is now settling in because in a couple of weeks he graduates, and it's, you know, we went through the math to try to figure out what kind of income he would need to have in order to pay that debt, and so we did it from a backward standpoint. We said, okay, this is what your debt is. This is what your kind of income you're going to kind of be looking for so that you can still pay your debt and still have room for play and taking care of your regular things. So I came across this list of tips. First one, create a realistic budget. So you do want to maybe sit down with your parents or have your parents sit down with your college-age child and just kind of go over it and really come down with a realistic budget for them. And establish financial limits. So live cheaply, have that conversation, whereas, you know, that's great, you've followed your passion, you have all this knowledge, but understand that you might not be able to live the way you want to yet. There's a couple more things that you still have to do before you can get to over that hump. So live cheaply. Get a job. Get a job.
Any kind of job.
And, you know, sometimes, especially when you come out of college, a lot of times it's internships. And there's not a lot of money in internships, but it's a means to an end. So it might mean take that internship, but have something else on the side. And, that support, that family support of, helping you through that is extremely important. But you may need to get that job, and it might not be your ideal situation, but it might be a means to an end at that
Okay.
moment. Um, Exercise caution with credit. You already have debt. Don't add more.
Okay.
So it's one thing to have a credit card. I would say have a credit card, have your debit card. That's it. There's no need at that age to have multiple credit cards for every little thing because it's a discount at a store. That is going to end up hurting you in the long run. So exercise caution with credit and use the technology to help you manage your money. In today's day and age, there's so many great apps out there to help you manage your debt. There's so many apps to help you manage your assets. Maybe you want to save money. Maybe it's not about debt. Everybody's a little different. Maybe your child is very astute in handling his debt, but maybe he's just not saving any money. So there's apps for saving money. There's apps for helping you manage your debt and your bills. There's Amazon Alexa. That's actually one I use. I know that sounds crazy. I actually use Amazon Alexa. She has her bills, she has her things, and little notes pop up and
Really?
shopping. So
Well-
these are the three most popular ones for finance app. There's Mint. There's you need a budget.
Yeah.
I'm looking at the initials there.
YNAB.
YNAB. And
YNAB.
it's you need a budget, and then Wally. And each one is a little bit different for managing your money, but it's truly important. It's a great conversation to have with your children and keep those communications wide open.
And there's many others, but you find that these are some of the best ones out
Yeah.
there for the average college student just getting out of college and starting the new life.
And whatever works for them. So it's really just whatever works for you. Those are just apps that might be able to be a little more helpful for you.
And negotiation skills. I think we were talking about that, on how when students are looking for a job, and what are some of the things they could be asking for in taking the job? Remember we talked about this?
Yes, so many students, they're vulnerable, which is kind of ironic because I believe that the students of today are probably the brightest.
Yeah, the smartest generation.
It is insane, and they really just want to.
Change the world.
They do. They want to change the world,
They do.
and they have the ability to do it, and they have that confidence. But when you're right out of college, you might be a little intimidated when it comes through the whole looking for a job and asking for what you need. But be aware, there's a lot of, depending upon the industry that your child is going into, there are a lot of companies that having that open communication for negotiation you'd be surprised at what you might end up getting. So I've had students that have had that open negotiations with their prospective employer, and the employer wanted them bad enough where they were able to take some money off that student loan debt. They give you extra,
I think that's a really big tip. If you're looking for a job and you have all this student loan and you're getting an offer, make the ask.
If you've got those grades and you know
Right.
you're the right person for that job, see what they're willing to help you with. Mention to them, I have debt, and is there anything? Sometimes it'll be a signing bonus, and a lot of times, what they'll do is they'll take that signing bonus. They used to call it a signing bonus, but now they'll put it towards your student loan. So even if it's just a couple $1,000s, it's a couple $1,000s that you now no longer have to pay. Credit scores. The relationship between the student loans and the credit scores is basically two stages. The application stage, obviously, and then the repayment stage. So the application stage, while your credit score may be low, when you're applying for federal loans, they don't care about your credit. It's a simple thing, you know, you don't have credit, that's okay, we're still gonna give you the student loan. When you go to repay the loans, that's when you need to worry about what your credit score is, and a lot of students don't have it because they just don't have the income at the moment. And that's where you wanna be very careful. So with student loans, it doesn't count as much towards, their credit score, but it does still count. Whereas private loans through banks, it's more heavily weighted. Your student loans can affect your Social Security. So just as an example, you can check out what your Social Security benefits would be online. That's available to everybody
okay,
right
that's right.
online. And so I did kind of a quick little calculation forthcoming, and we figure if you were born in 1997, you'd be graduating this year, and when you would be actually going for your Social Security, that would be in 2059, where you would be 66 years old.
Okay.
And say you were earning 75,000, that's average, 75,000. So maybe a student coming out of college isn't gonna make 75,000, but over the course of several years they do. Calculating through what that person's Social Security benefit would be, assuming no increases, which is highly unlikely, their monthly Social Security payment would be $1,706. $1,706. Now, just for the sake of argument, we're gonna leave it at that.
In
So
2059.
Junior,
In 2059.
junior never got a raise.
In 2059, that's gonna be like chump change.
Exactly. But when you take 15% of that, that's a time period where, you know, at 66 years old, you need your retirement. You need your Social Security. There are thankfully, we're becoming we're a generation, and generations after us are becoming more health conscious. We're living longer.
That's for sure.
But again, that comes with its own things. If you're living longer, you don't want to outlive your money. So you are gonna depend on that Social Security. You are gonna depend on your retirement planning, which is why you need to get a job at a bank. But you want to, those are the things that will help you, and those are the finance lessons that you do want to have with your child today, about retirement planning, about that. Outliving your money is no way to spend your retirement years, and that doesn't include, say, something comes up medically speaking that you have to pay for. My mother, when she left banking, they covered her medical for like 100% for I don't know how many decades before they stopped it. That doesn't happen in today's world.
Right.
You retire and medical stops, your
That's
medical benefits stop, your dental benefits stop, and you need to have that benefit with you. You need to have that extra cash.